thought, what better way than to have some weekly office hours? Some weeks we'll show up with projects we're underwriting or projects we're raising capital for, or projects people have brought us, and we'll walk through underwriting and share all that. And other times we'll just have it open for questions. You can bring your own projects or your own things that you've got questions for. We'll always try to make time for questions no matter what, even if we're presenting a project we're working on, but pretty chill. Just want to be here to support folks any way we can. So questions, anybody got questions, or you want to share a project you're working on, or can we, yeah.
I've got a question. So, hey Tracy.
Good to see you.
Good to see you too. So I'm almost done with the co-living semester, and I've been, diving around in the market insights and pad split, which is really it's just invaluable information, a lot of content, and
right.
And analysis that they give you. Yeah. So the only kind of, and I've been watching the underwriting that you all have been doing. So the only kind of, I guess, concern I'm running into is Atlanta's not really a public transit friendly area.
You say
so I know that Atlanta, yeah, I'm in Atlanta. So I'm looking at the suburbs of Atlanta, like Stone Mountain, Mableton.
Yeah.
And then actually closer to me, a little bit north of me, there's actually some really strong markets. But it's kind of surprising that they're so strong given there's no public transportation. And I know that's something that you all would map out when you would look at your location, how close it was to bus stops and such. Do you think that that should I not give it as much weight when I'm doing my underwriting, where the proximity is to transportation?
Do you want to talk about that? Because one of our projects, you're on our Tampa one, but the one before that was actually in Stone Mountain.
Right.
Yeah,
So just wondering if maybe that's something I should just give as much weight to.
Which sort? What are you using? I've noticed different sources show the accuracy of bus stops better than others.
Yeah, that could be it too, but also just living here.
Okay.
I mean, I know that we really don't have a very robust system. MARTA only goes so far. The buses don't run with a lot of frequency. Yeah.
How is your Uber Lyft's access? Yeah.
Those are good. Yeah.
A lot of people do use Uber and Lyft. You might then consider, Gus, I'm curious your thoughts. You might consider places where there is more parking or an opportunity to add more parking, like Tampa, right? Okay. You know how we talked about if we had to, there's so much room on that property we can make a bigger
driveway or parking pad.
Yeah, so literally right now we're doing this at Port Orange. It's going live any day. All the furniture is built, all of it. We're renting a couple of spots from the neighbors. So it's like 5 birds, one stone in a sense, where it's usually the biggest problem if something happens with a pad split is your neighbors are mad at you. So we're giving money to the neighbors on this instance.
I love it. Incentive.
And so,
incentivize.
And we needed this space too, because it is 8 and the existing driveway only 4 could fit. So we can put 2 kind of on the road. And then I think we're giving a neighbor $70 per car per month, something like that, 70 or 90. Mm-hmm. Is that something that you think would work around you?
Yeah, I think that would work. I've been trying to, when possible, looking at properties that are on a corner lot. So the parking spot is, obtrusive. But yeah, I've been looking can I make the driveway a little bit wider or kind of have it run alongside the garage so that someone can park alongside of it if they can't get in front of it.
Mm-hmm.
Yeah. Okay. Thank you.
Yeah, that's great. Any other questions? Can I answer for you?
Hey, Tracy, I got something real quick. I've been, last 6 months, I've been running with scissors. So I've got 4 co-living properties. 2 of them are sober living, which are fully rented. And I have 2 co-living that I just finished renovations. I'm about to rent those. The biggest sticking point I have right now is finding a DSCR lender and insurance. I'm sure I'm not the only one. So I'm just looking to see who's already cracked that nut or at least has some options Because I've
Have you already converted it into co-living?
well, I learned my lesson, so I went ahead and refied one before I put in like the last wall for the dining room, just so it looked like a single family. But I did get caught on my first one, so I'm trying to figure out if who's a little bit more lenient on those.
Without having, at least in our experience, right, without having 12 months minimum of positive cash flow, I don't know anybody that will lend on that.
Okay.
There's one you could try. We haven't gone with her. They don't sell the note. At least ask her. It's Mandy Konecki. I know they want seasoning on funds, like I think a couple months. But it's worth a shot. I know they're at least open to it, and I think that who they work with, they do buy them, but they are, remember, a little picky, at least for what we were trying to do.
Okay. Or is she in Subto?
Yeah.
I think I have like a link to her lending page also. I can look for that real quick too. But she is, Konecki with a K, Kone.
Yeah, she's located in Jacksonville. She hosts one of Pace's podcasts, Get Created Podcast, too.
And it's Konecki.
CKI. Okay, perfect. And for insurance, has anybody, broker or an actual direct company?
Steadily, you could try Steadily.
Yeah.
It depends with them, I think, on location. And then I don't know, like on one of our properties, they wouldn't insure all the up to 11 bedrooms. And on the other one, they're like, sure, no problem. We'll do 10. Like,
Yeah.
I don't know what, you're like, is it just you're having a bad day? Why are you?
I don't know how you insure only part of the bedrooms in the house, but.
Some people don't say that they're doing co-living. I don't recommend that. I think that's not smart, because if something happens and it comes out, and it will come out, especially if it's a major claim, then they could just deny paying the claim.
I did find one insurance company through my broker that would do, basically they consider it a group home. But it's actually not that bad. It's basically in Oklahoma City anyways, it's about $250 a month. So it's
great.
Not bad at all. So
no.
But yeah, so I'm just looking for other opportunities. Yeah, I've reached out to Steadily, but nothing there.
Oh no, they wouldn't insure you?
No.
I'm trying to think who we have right now on. I'll mute myself in a minute and I'll look to see too who we have for our one larger property. It might actually be Steadily, but I'll look to see.
I appreciate you.
Yeah.
Nathan, which states did you say? I don't know if I caught it.
All mine are in Oklahoma City.
Okay. I mean, the only one I've heard of lately with co-living or insurance being a little extra finicky is Florida, but I mean, I'd be surprised if you can't find it there.
Okay.
Yeah, I mean, that's where our Tampa property.
Do you already have a rep, a pad split rep?
Yes. Long story short is we did put one on the market, and then some other internal things were causing problems, so I changed it into a sober living. So yes, but we haven't really gone through the full process yet.
Because they would be a good recommendation.
Okay.
They should have a good recommendation as well.
Okay. I'll reach out to them.
Yeah.
Okay. Thank you guys. I appreciate you.
Our pleasure.
Hi
Yeah.
guys, it's Roberto.
Roberto, what's up, man?
How's it going, man? So Nathan, I wanted to address that too. So last week I spoke to a lender, which I believe, I think we're working with him, Fernando Corona.
Yeah.
I spoke to him, and he presented a bunch of different options of how you can finance a property, from DSCR loans to Even like if you have a business, you can use your business accounts to prove that you can pay for loans. So there were a couple different strategies that I found interesting, and one of the things that he was open is that he can get loans for existing pad splits or existing co-living. He has a couple different lenders, and they have different requirements, but it might be worth talking to him. I can introduce you to him, so I can send you his contact info.
Yeah, I appreciate that. And I saw your blank, so I'll connect with you too.
Yeah, do that. We're into, you know, just while we're on the lending topic. So we're currently in escrow on 2 loans with Fernando, 2 different lenders that he has access to. Just keep in mind too, when you're a little bit different for you, Nathan, because you already have properties, you're kind of doing your thing. But when you're newer and you're out kind of looking at properties and you're talking to people, you're going to have a ton of brokers tell you, oh yeah, I could, oh yeah, we got all these different products. And they do. But when it actually comes down to brass tacks, there's all these different pieces, you know, that they don't often bring up front.
Yeah.
So I recommend, from our experience, you really have a serious conversation with them and about maybe even bring a property that you would potentially buy. Maybe you're not going to buy it, but it's something you would potentially be interested in, or something that fits your buy box. Go to that meeting with that property and say, what would it look like to get a loan on this property to do this situation? Because, and even still, you'll find, I mean, we really like Fernando a lot. We're really, we're very grateful for him and his team. And it's also been a lot of hiccups along the way with different things that, because it's co-living, because maybe you're going to bring in an equity partner or something like that. Because a lot of times you do have equity partners on these projects, because otherwise you're putting a lot of cash out of your pocket. So yeah, I just always say to people, sit down with a couple of different lenders and build a relationship, and really, but push on them, right? They're making good money off of you at the end of the day if you go with them. So push on them a little bit, bring a property to the table and just say, yeah, let's walk through this. I'm thinking about buying this property. What does that look like?
Yeah, and if you can get them to put it in writing, so it's like just clear what was communicated, easy to reference.
Oh yeah, follow up in the email with nobody's business.
The terms, the seasoning.
Yeah, you want to get a term sheet. Always get a term sheet. Yeah, Fernando's a great guy. He's probably, him and Jeff Weller are really the only 2. Jada has brought on some new products. It sounds like we haven't worked with her on a co-living property, but she sounds like she's brought on maybe a new lender that might have a product as well. So you might reach out to Jada as well. But Fernando's very passionate about being able to help people grow their co-living portfolio with lending products, right? He's super committed to that. He's a great problem solver. He definitely will get in there and do what needs to happen. You know, he'll reach out to the underwriters and so forth if that is necessary. So he's a good guy and definitely a good person to work with. Probably of all the people I know, I would start with him.
Thank you, Tracy.
Mm-hmm.
I have something else, if I may.
Yeah, and then we'll pop over to Joy. Absolutely.
Oh, sorry. Am I skipping somebody? Hey, Joy, you can go. It's okay.
Hi, Joy.
Oh, hi. Thank you. I have one pad split in Phoenix, and like what you mentioned earlier, you know, I use my own money and a hard money lender, but in order to scale, I want to, you know, get your thoughts on like how you did your capital raising that you did with one of your properties. How do you you know, how do you go about it? Because I'm thinking of buying another one, but this time doing capital raising.
Which one of you guys wants to speak to that?
I can speak to that.
That'd be great.
So
Thanks.
what we do, which, how do you say your name? Joy?
Yes.
I'm in Phoenix, by the way.
Oh, hi.
I mean, what I would recommend is probably, I mean, like partnering up with people, you know, like I wouldn't recommend like, you know, you can either do it yourself, but gonna be with like one slow, you know, you slowly gonna be able to build and scale, or you can, you know, kind of meet people in places like this, communities like this, and kind of build one team similar to what Tracy, Dustin, and I did. I mean, you know, we built one team and we all have like our own specific roles, and it allows us to scale, you know. So I mean, and in terms of just kind of raising the capital as well, I would probably find one, you know, people who's already doing it maybe, and trying to kind of, you know, partner up with them and whatnot. Or if you get one really solid deal, you know, being able to kind of talk to the deal, present it, maybe present it to people you know first, you know, and then kind of bring it out to the community. But there's different ways you can do it, right? We, in the past 2 deals we did, we used the platform on Fractional. Were you able to see our raises, how we did that?
I did. Yeah. And yeah, I know you from Race Masters. You and I have
Oh, yeah.
a standing. I haven't responded to your
Oh, KK.
your
That's right. Yeah.
message to me yet. So I was wondering about that, how, because I want to start doing it, you know, what I've been learning in Race Masters, to start doing it. But I did watch your fractional and how quickly you got to get the investors funded.
Yeah. So I mean, I'm gonna be transparent. Like for like Raise Masters is kind of different, right? Like they're gonna, you know, Hunter kind of teach us a different strategy. You kind of look at like SEC compliance, and you talk about, you know, creating fund of funds. So in Race Masters, they're building fund managers, right? They're building fund managers to work with the big operators and you know, go tackle deals with only accredited investors, right? Unless you already have one solid black book of accredited investors, right, that you can kind of tap into and present your deal. You know, the barrier of entry, and most of the people that we kind of observe that is interested in like this, you know, asset class and this model is more of probably like non-accredited investors, right? Investors with maybe 10 grand, 5 grand, 20 grand, and so forth. So you would have to kind of focus on those individuals when you're thinking about building one team. You know, if you're gonna start using accredited investors, then you're gonna have to, you know, get one SEC attorney for draft up documents, create your PPM and all that stuff, right? So, and I think it would take you longer, in my opinion, to scale using accredited investors unless you already have one solid network of accredited investors wanting to do this. Does that make sense? The accredited investors is looking for multifamily. They're looking for like different asset classes right now. I'm kind of going through that now too. Like plenty of my accredited investors, they like different type of deals, you know, even though I talk to them like a lot, right? They look for, they're more into a different asset class, larger deals, more stability, things that's already been out there, proven, and you know, for a long time.
Okay, yeah, that makes sense, because I did watch how your first fractional, you got them to fund the whole deal, but I'm just thinking about the bookkeeping though. You've got a bunch of people with 5,000, but then how that's a lot of bookkeeping.
I mean, actually, our potential Rhonda Chan on here, she's on our call right now. So she's on here right now. Actually, we have a meeting with her next week, Monday. She provides all that types of services and can handle that. But I mean, that's the same thing like we discussing with one team, right? Like we outsource as much as we can, you know, and just kind of stay in our lanes, but we kind of outsource and find team members to kind of fit every role. And I mean, that's kind of like what, you know, Dustin is great at that. Like he brings in a lot of firepower to our team, right? But that would be my recommendation. Try and partner up for now in the beginning.
Yeah.
Oh, okay.
Joy, fractional, one of the reasons we use fractional is they will actually manage the back end of those raises. So it is a lot, like to have 20 people, you would need a team to manage all that for you. So that's why we pay fractional. That's what their fee is they manage setting up the multi-member entity. They manage the bookkeeping for that entity. They do the K1 distributions for that entity. And then your personal bookkeeper, then that's just an entity that you're part of. Right. So that is part of what they do. But I also wanted to share that to like the capital raising part, you know, how do you get investors, right? Because fractional is not bringing investors to your capital raise. That's you, right? That just takes time. You know, Dustin and I and Kaipo have been in this industry for years. Dustin and I did the co-living semesters. That was also very helpful. But, you know, Dustin's been wholesaling for 2 years. He built up a big rapport. Kaipo's been raising capital. I've been raising capital. This is years for the three of us of building relationships with people. And that's why we had 150 people show up and we raised $300,000 in under an hour. But that's years of relationship building. So it is just taking time, but it's also experience, right? So that's, you know, part of why we have created our project where people can come and invest with us, because not only are you gaining, you know, you have equity and cash flow, but you're also gaining experience that you can put on your resume, whether it's for private money lenders, equity partners, or long-term debt. They all want to see experience. We just today had to submit our resume to a lender, one of Fernando's lenders, explaining our combined experience. How many assets do you hold? What type of assets are they? What's your income from the assets? What's your real estate experience? What's your personal experience? And so all of these things are important. And so, you know, those are the things that you'll be presenting. You'll want to learn how to put a pitch deck together. So I think to Kaipo's point, you know, you're either going to invest with another partner that has the experience, you're going to orbit somebody that has the experience, you're going to join a partnership like ours with people that are doing it and teaching you. There's a lot of different models, but you're going to, you know, yeah, you'll just need that time and experience. And then, you know, it'll come.
So it's like, because like I keep looking and underwriting properties, you know, day in and day out. And then it's the capital that I'm, you know, it's like, do I make an offer now or do I wait to raise capital first?
Oh my gosh, no, because what are you going to do if you put in an offer? You only have, you know, most people don't even want to do, you know, you're not going to get a 30-day inspection period. You're going to get
right.
And how are you going to raise that capital? I mean, here's another piece to consider too. Not only are you having to raise the capital, but who is in your team, or who are you going to hire to do all this paperwork for you? Right? Your TC is not going to draft up your multi-member operating agreement or your private money partnership agreement or your private money loan agreement or any of that, right? And if you're doing co-living, you're not going to, you know, how are you looking for a private money lender? And if so, how are you paying them back? Are you looking for an equity partner? And if so, what kind of equity and cash flow are you going to give them? So I feel like lots of little pieces that you might want to dial in first, because I don't want to see you buy a property and then go.
So Joy, there is one thought that comes to mind. Depending how you bought the first pad split, it's stabilized, and you could consider selling a percentage of that stabilized part. And now you have new money to inject into the second property.
That's so smart.
And then it could eliminate a lot of the, it helps.
Yeah, that makes sense. Though so I have to figure out like Do I open up 50% of equity right now to another?
How long has it been running?
I did it since December of last year.
And it's profitable? It's
Yeah,
stabilized?
It is. It's a small one,
Maybe.
5 bedrooms.
It could be now or it could be in a couple months, fall. But once it has history, you could sell a spot, really. And then now it's like you have
Really good
some
point.
new capital for the second.
I'm struggling with that idea of how do I present it? Like, do I offer 50% of my equity, or and then the returns would be like, like 7%, and then
It doesn't
Yeah.
have to be. It doesn't have to be 50%. But I love this idea because in a way, it's a lot easier to get a capital partner once you can demonstrate how the property is doing. So that's a great idea. And it doesn't have to be 2%. You can do like whatever you want. You can whatever works for you and whatever works for the capital, whoever wants to put their capital at work.
Yeah, because maybe
Yeah.
it's 2 people
I like it.
or
Yeah,
something.
I like that idea. I'll try to figure out how much money I need, and then how much, so that I know how much to raise, and then do the pitch deck basically, but to offer the partner. Thank you. Thanks, everybody.
I have one question. Joy, you're part of the fractional, just our community already?
I did sign up because of you guys' presentation.
Okay.
So I think I am.
Okay, in the, if you're in fractional, you can look at the previous deals, and I mean, there is Dustin's, calculator kind of breakdown, and then maybe that might be able to help you kind of structure, or, at least give you some ideas how you may be able to structure your deal.
Oh, okay. That's very helpful. I didn't know that I can do that.
Yeah, so when you
Yeah.
go into the community page, you click on projects, and the previous project's gonna pop up. And then in the actual project, there's everything in there. So there's, spreadsheets and everything like that, Dustin used for underwriting and everything, and it's kind of broken down in a way where, might help you structure your deal, give you some ideas. Yeah.
Oh, great. Yeah. Appreciate you guys. Thank you so much.
Yeah, that was a great feedback, you guys. I love it. Hi, Angel.
I was muted. I have a very basic and simple question. So I'm not there yet to do pass split of my own of getting a property. So I was thinking of going through fractional. But if I were to do it through fractional, I guess my money will be locked in for at least 5 years, I would say. Is that right?
Oh no, that's just how you mean with us or on your own?
With you guys, let's say if I go through fractional, because I don't think I'm there to get a property and do pass split of my own, because I there's a lot of things I don't know. I don't know what I don't know. So and I wanted to know if I get in there and let's say you tell me, hey, 3 years you have this much return, but let's say if I can't get through the 3 years, is my money stuck there for 3 years? Then nothing I can do, or you'll buy me out, or how?
Yeah, great question. Yeah. You want me to go over that, Dustin, or you want to?
Yeah, and let me add one more question on top of that is also I have a question on tax purposes. So let's say if I wanted to do bonus appreciation, how would I do that? I mean, because I know linear appreciation, I can do that, but I have a W-2 job, so I want to see how would that work in the fractional. I mean, I know that you guys have a presentation when you did the fractional thing, but didn't catch all of it. So now I'm at the office hour, so I have those questions.
I'm gonna let Dustin answer that because he's definitely better at the tax side of things than I am.
Oh man.
Angel, have we been texting?
Yes.
You
Yes.
were texting yesterday?
Yes.
Okay, you're the guy with the question.
Yes.
Yeah, that's.
Yeah. Well, it's funny. Tracy and I, before this, we were talking to someone about this exact subject, the second part. On here, you'd definitely confirm all this with a CPA. Like this isn't chipped in stone or
Yes.
anything.
I trust you guys. You guys already done all of that.
We're non CPAs.
Yeah.
I won't hold you to it, but
Yeah.
I'm sure you guys know better than.
Yeah. Well, so the first part in terms of the 3-year, like we are offering, ultimately it's we would get first right of refusal to buy you out in a sense.
Mhm.
And then I know there are a couple of different ways, like you can, Kaipo knows the fine print better than I do of like kind of selling a spot, that kind of stuff. I mean, the first thing would be talking with the pool of investors within that property.
Mhm.
But I do know we are exploring, this is newer, but there are some like second lien DSCR products emerging out there where it would, the LTV is like 85%. No, these are newer, so I wouldn't bank on it, but they are emerging. And then the second part, in terms of the bonus depreciation, I know it essentially that hack, the W-2 hack, buying the Airbnb is kind of the more common route. You got to manage it so many hours, 7 days, has to be listed, kind of thing. I know that would be pretty tough on these, since it's we'd have to run it as the Airbnb first typically. I'm banking on Roberto to know more on this because I'm an agent, so I don't have to like do that whole side. I just know I have a lot of friends that do it. Like every November, they're buying at least 1 or 2 properties, running it as an Airbnb to get that extreme bonus depreciation. But I see Roberto's hand up as well, so maybe he knows.
Thank you.
I don't have a comment about this, but I'm waiting for the rest of your answer.
Oh yeah, which part? You're talking
No,
about
no,
just
Angel, did Dustin answer your question, or are you?
So I have so my question is that so that means that if I invest through fractional with a co-living, I would not be able to get much of a tax benefit. Would that be correct? Because I looked through the Excel sheet, it says like if you're at the 24% bracket, then you get certain amount back of tax benefits. I didn't quite understand that part.
You'd want to confirm with your CPA because I've heard Pace and he is aggressive on certain tax things, and I've heard the other end from CPAs. So you'd want to find it. I think the best thing is finding the CPA to tell you how viable it is.
Yeah.
Because I've heard a wide range, and so that's why I just dove all the way into real estate. I was like, I don't want to mess with it personally, but I know everyone.
So let me get this straight. So that means that it would be more beneficial to me in the tax sense to get a property and do a pass split because I am involved in the process instead of investing through fractional. Would that be right?
Well, I think what Dustin's saying is that, either way, you should be talking to your tax professional about this because, and the reason I say is that whether you're investing in fractional project with us versus buying your own real estate is exactly the same. It's the same. You are walking away with a title of real property. Same way. It's just with us, you're maybe investing $10,000 or $15,000, or you're buying your own and you're investing $150,000 or $200,000. So your return or your savings is just dependent upon your investment total, right? So it's really the same across the board based on your invest. So let's say you were going to go buy your own and you had to put 200,000 out of pocket.
Mm-hmm.
That same 200,000 invested with us, the tax benefit's going to be the same based on the earnings, right? And so it's really, I think, about strategizing with your tax professional, because they also know your tax bracket and where you fall and all those things. And
Yeah, because they're
Yeah.
also going to each one's going to have their own unique way of calculating your time, tracking it. So
Yeah.
right from the get-go,
Yes.
you'll want to.
Some are aggressive, some are conservative. But one of the things I will say is that as you're moving forward, if you're working with fractional or you're doing investments with other investors, be really mindful that be mindful that you are on the HUD, that you or your entity show up as actual owners, that you have ownership of the property, because that's how you're taking those, those tax benefits. At least from my understanding. I'm not a tax professional, but that's one of the reasons that we like to do it the way we do it, where all of our partners are actually on the LLC with us. And so that joint LLC is on the HUD. And so in turn, we are all personally owned together.
Can I add something to this?
Yeah, I have to hop off for a sec, guys. I'm so sorry.
Angel, so my understanding is, I guess it all depends on what you currently do and what you currently have. So I'm not a CPA, and don't take my word for all of this, but my understanding is that you have active income and passive income.
Mhm.
Active income is your W-2, your job, like is that side of things. Passive income, it could be real estate. Now, if you currently have real estate and you're getting some income from your real estate activities, or if you already have a rental property, let's say, and that's generating some income,
Mhm.
if you join, let's say, these guys' project through fractional, you will be part owner of the property, which in whatever percentage you are a part owner, you can use that as a deduction for your incoming income from your other passive activities. So in a way, I mean, that definitely you have to confirm that with your CPA on where the numbers fall, but you can definitely deduct the depreciation from real estate on other real estate activities, aka other passive income streams. So I don't know what your case is, but there's clearly a two sides of your income generating activities, active and passive. You can deduct everything from the passive, you can deduct it on the passive side. Everything from the active, you can deduct it on the active side. What you cannot do is use one deduction from the passive to deduct it on the active income. People used to do that in the 80s, I think. Like doctors used to be like so into buying real estate because that would offset their active income on their jobs. And at some point, the IRS said no to that. But again, talk to your CPA. But this is just a little bit of something that I know.
Maybe I need to get a real estate license and become an agent. I mean, then
sure.
All right, got it. Thank you.
Let's see, Roberto. What's new in the past week? I know you're staying busy. What are you buying anything new?
Thank you. So I'm on the hunt. That's basically where I am. And I've been pushing really the road of connecting with wholesalers, bird dogs, just like getting some deal flow coming my way. And so I guess this is a question mostly for Dustin, I would suppose. So one thing that I've been putting together is I'm an integrator in another team, and the Rainmaker, so I know the tool. So what I decided to do is to do a little research, compile a list of properties that could work for co-living in the different markets that I'm looking at, and share that list with teams or wholesalers that have the manpower to make those calls and get them under contract and just bring them back to me. So that's one of the things that I've been putting together.
I could show you something. I don't do this anymore, so I don't need to gatekeep it.
So my question was going to be, and this is, I'm just starting this by painting the picture of what I'm doing on like how I'm trying to get lead flow right now, or at least like connecting with wholesalers and bird dogs. The one thing that I guess like a little detail is that when I'm creating these lists or pulling these lists with deal saws or PropStream, there's the issue of the HOA. Like it seems like, especially with deal saws, I cannot filter properties that do not have HOA. I think in PropStream you can do that, but in deal saws you cannot. But I was wondering if you run for that, and like if you've pulled lists that do not have HOA, or how do you filter those?
So I got lucky, or whatever you want to call it. I was able to jump on the LOI Blaster wave almost 2 years ago, like way before it got, I don't know what the right word is, saturated maybe. It still works by all means. But I caught it early, like to the point where every agent that was receiving my emails, they're like, this is a scam. Now it's a lot more like, they might say it's a scam. Anyway, what I did was I used a scraper on Zillow. Look up Bardeen. It's like $15 a month. You could create your own list on Zillow, no HOA, scrape it, and then what I did, I don't have this memorized the exact step. I know you can do it on this like PropStream. I'm pretty sure you can do it on DealSauce. All right, I generate my list on Zillow. I'd scrape it. I would import it into a Google Sheet, clean it up, and then I would import it into PropStream, and it automatically align all the emails because that was the biggest thing missing. And then I'd pull it again out of PropStream, and then I'd put it back in my Google Sheet, and that's how I blast all my emails. So you could use Bardeen, like use Zillow and Bardeen, scrape a list, make sure it definitely doesn't have HOA, and just cross-reference. I know that you can use ChatGPT to cross-reference, like pull the same list in DealSauce, Zillow. You don't know the HOA quite yet, and then use ChatGPT to eliminate maybe. I did it. I haven't done it in a while, but I have done that before.
Yeah, that's what I've been playing with, like the different tools to clean the list. But I was just wondering if there was I don't know, like easier way or quicker way to do that. But I see what you're saying for sure.
Yeah, because I used to only, before DealSauce was even out, I started with PropStream, but I didn't like the quality of data. And so I just started pulling all my own data from Zillow and then cleaning it. And then I'd use PropStream just to pull the emails to finish my list.
Okay.
But yeah, Bardeen, I know it's evolved too with AI. Bardeen does wonders. $15-20 a month.
Why would you scrape it from Zillow if you have the same info on like a DealSauce or PropStream? Do you find that
It
there will
was
be
the HOA for DealSauce example. So it's like you could. I noticed PropStream 2 was slow, so it's missing some data. So you could like create your co-living criteria on Zillow and pull it, and then export it into a list, and then pull the other list from whatever source, and then just compare, like just see which had the HOA.
Okay, so you're using the data from Zillow just for filtering the HOA portion of things.
Yeah, in this scenario, yeah, it could quickly identify who has HOA versus not.
Okay. Cool. Yeah, I'll work on that. So yeah, that's basically what I'm doing. I'm trying to get a clean list of properties that could definitely work and bring it to the wholesaler community and and share it so that they can do the calls.
Yeah. Well, I mean, the emails, my opinion, the emails, like if you do it right and you can take the extra steps to make sure your emails are being delivered all right, then it's just reverse engineering some KPIs of how many emails turn into a deal. But don't use the same email that everyone in the LOI Blaster uses.
Yeah.
Like customize it. I actually had mine when I was doing it a lot before we started buying a ton. I had people go to my LinkedIn, like made it look. I was like, here's my YouTube channel, here's my LinkedIn, because a lot of people at wholesale, they try to like hide.
Okay. Yeah, just get your credibility out there.
Yeah, and then you could have a couple guys on your emails. It's their phone number that the agents are calling. So it's more like I call it like Kanban, like 6 Sigma. Like it's a warm. In a certain type of business, it's warm. It's a warm lead. So they're not just cranking out 8 hours of cold call. It's like the only people they're talking to are just warm.
Yeah. The thing is that I wanted to avoid. I've worked with I mean, I'm working with a wholesale team, and you know what it's like having a wholesale team. It's a lot of work. It's a lot of yeah, it's a lot of work, and so I totally appreciate when the property gets under contract by a wholesaler. So I want to avoid dedicating my time on managing a team or a group of people that are an acquisitions team, let's say. I rather help the acquisitions teams that are out there to source the properties that I know that have a good chance for them to be good for me and for the community. Like if this works, once we get like deal flow, like then we can share the wealth with other people, because I'm not going to be able to buy all the properties. But if there are properties that fit certain criteria, there's other people like in this group that are interested in the same kind of properties.
Yeah. Yeah, like Devin, he's buying lenders.
Yeah.
So anyway, but yeah, thank you for the tip. I'll take a look at that.
Yeah. All right, Tracy's back. Let's see, we have 6 minutes. Did we have any last questions? Any lingering questions from someone? I see a bunch of people haven't talked.
Okay. Good deal.
Let's see, Devin, did you make any progress on since we last spoke about what you're deciding? The wholesale versus just focusing on buying?
Yeah, I've pretty much told my partners it's co-living and co-living only. We're not going down any other rabbit holes.
Good for you. Yeah.
We just got our first offer out on property out in Nashville today. That'll look at if we can get it set up for 12 rooms, looking at over, I think, 22 to 23% cash on cash return.
Nice. Is it close? What's it close to? Anything specific, or are you just like location overall?
No, it's bus stop is right down the road from it, and it's right there up in as far as close to downtown Nashville and everything. And the bus line that runs there in Nashville goes all the way out to Nashville International Airport and all that. So it's right in the heart of stuff. And if we can get this property, there is another property that was built right behind it that we're going to work on. But these two combined, we're looking at over $1 million. And just, as far as $1 million in real estate.
Nice.
So it's going to be a big one.
Yeah, that compounding appreciation over time will be nice.
Yeah.
Most definitely. That's great, Devin. I love that.
You guys pretty much prefer if you can take, it's like I know, so Chris and Angel, they've got about 135 doors of co-living. And they say pretty much they try to stick with just the creative and going after creative opportunities. You guys, is that more what you guys would prefer to go after as far as the creative side?
I think it depends on your team. Like we're buying a few different types right now, and some demand way more time and effort, right, Tracy, than others. Like
Oh, yeah. Yeah, I think that, that's a really, it's really true what Dustin said. It's like, it's really about your team and your team's capacity at that time, right? So, like, how many properties do you have under contract that you're working with a lender for debt service? How many are seller finance? And that's already gone through. How many equity partners do you have? Do you have the capacity to bring on new equity partners or private money lenders? I think it's so like, we're just deal by deal. And then after, we've closed on things and we're like, okay, take a breath. Okay, what's next? And then it's like evaluating what the team's capacity is.
Yeah.
I don't know, guys. Does that
like a perfect example on this call? Today we listed a flip, Tracy and I, and we got an offer.
right?
while
And
we're
we
on
got
this
an
call.
offer already.
But the only way
Nice.
we even did it in the first place is because we had a team that we like trusted to tackle it. Numbers were
Yeah.
great. So if it was just Tracy and I that tackle on the flip, there's
Dude,
no way
we
we
would
did
be
it.
underwater right now. I would be crying, you guys. I would not be here and I would be crying.
So it's like my email's getting blown up, DocuSigns and all this stuff, and I'm like, what is happening? But anyway, it's the team. So I think Chris and Angel, like you mentioned, they've modified and sculpted their team to handle that, whereas
Yeah.
others, there's plenty of different scenarios where you don't have to have that team a little more hands off.
Yeah, I would say we're definitely not for or against one thing. It also depends on me. For me personally, it depends on, I look at every deal by deal, and look at, what does that look like for short term, long term. I do love, don't get me wrong, I love a good creative deal. Co-living, you have to figure out, how am I going to pay that money back, right?
Yeah.
Where am I going to come up with the down payment, and how is it going to get paid back? Because if it's a good creative deal, you're not refinancing out. You're holding it for however long you can get that balloon.
Yeah.
So, but that's okay. You just bring in an equity partner, or you find private money that's willing to hold for a long time.
When underwriting properties for like DSCR, do you guys have like a certain threshold as far as purchase price you guys to look at? Do you guys stick at the 500,000 and below, or?
No, not necessarily. No, I would say it's more about what fits our portfolio and our investors' appetite. I don't know. What do you say, Des?
Yeah, I'd say the sweet spot lately, not that we won't go above or below, but it seems like 400, 500, even up to 600. It really comes down to how spacious it is, because it could be like a 700, but it's already, like Tracy and I were underwriting a sixplex earlier today. So it's like, it's definitely above 500, but penciled out pretty nice.
Oh yeah. Yeah, it's well above, and it penciled out really nice. Yeah. It's gonna be good investment for them.
How do you go about as far as underwriting for like DSCR? That's one thing that I haven't figured out. Like, I can look at the creative and come up with terms for like seller financing and stuff. But as far as looking at DSCR, that's one area that I have not figured out for underwriting.
Just assume your down payment's going to have to be big, a lot bigger than 20%, because they're going to need that rent rate to be at least a 1.0 on the PITI. So they always say like 20-ish%, but at least in this co-living sector, we're just automatically assuming at least 30, if not higher. They're like one we're looking at, I think our down payment's 30 or 35, and they're like, oh, because they're using the LTR still to calculate your ratio.
Yeah, they're not going to use the pad split rents. They're going to use long-term rental rates, Or if it's in a short-term rental area and there's some way you could make it seem like it's gonna be a short-term rental, they might use, you know, some air DNA. But typically they want to look at just long-term rental rates.
Yeah, because that was the other property that's behind the one that we just sent the offer in on. It's a brand new construction, and we're looking in the 700,000s on it. But it's, I think, almost 2,700 square feet and 4 bath. Right now, we of course want to up the bed count to, but that was what I was like, how do you turn around and make something at that price point pencil out?
Yeah, that does seem, I mean, I don't know what the bedroom rent rates are there because I don't know the area. So it would take, you know, but
We're
again,
running over 200,
yeah,
over 200 units.
it's not a lot really considering that's a lot of debt to take on. How many rooms do you think you could get out of it?
Would probably look at maybe 9 or 10, I think. The other house that we're looking at is, I think, about 2,900, almost 3,000. And yeah, we're looking at 12 rooms. It's a 7-bed right now.
Yeah. Well, we do have some underwriting